Welcome to this webinar, Trading How to Survive and How to Thrive. I'm Janne Muta, Chief Market Analyst for TO Markets, and it is my pleasure to have you here. It's one of the sort of best sides of my job. That's the webinars. One of the best sides is to sit in these webinars and teach you and help you to learn new things. Let me just see. Okay, cool. Everything should be ready. So we are going to start. First of all, let me just remind you that all the views expressed here are made available purely for educational and marketing purposes only. We do not provide investment advice, and it is all the material that we provide is there so that you can learn, you can do your own analysis, and you can incorporate some of the principles into what you do, some of the principles that I share into what you do, and you can take it from there. So I'm glad you are here, and all those people who later on watch this on video, I very warm welcome to you also. Great to have you here with us. So the last time I was talking about seasons, and I'm not going to repeat a lot of things in this webinar, but it still makes sense to repeat some of the things because we remember better. We sometimes need to hear some things again so that we understand what's worth remembering and what's really important. So there is season for everything, also in trading. Some time ago, I was looking at this market. This is gold in a daily time frame. I was looking at this market and I was seeing some things that we're going to go over today so that you have an idea of what I was looking for, what you can do to basically copy some of this stuff and incorporate this into your own sort of analysis and decision-making process. And as you can see here on this chart, definitely there are seasons. There are seasons when market goes up like here and little rallies earlier also. The problem, trading is going to be very problematic for you if you get the season wrong. If you keep on selling when the market is moving higher, or if you keep on buying when the market is moving lower. So if you get the seasons right, if you get the rhythm of the market right, then you are doing things correctly. And I'm here to give you tools on how to limit those situations where you get it wrong and to increase the times when you are getting it right. We all have to go through this learning curve where we are taking, we just make mistakes and we understand things differently or wrong, because it's always so easy to see the chart once it's ready. But when you have only the current price here and you have to make a decision whether this is going to be a buy or sell, that's harder. But there are principles. I'm going to share these principles with you now, and probably there's something more that you should learn, but I will share you some very important key principles that will help you in your development as a trader. So what happened after the publication of my analysis? Market rallied over $100. I was saying down here that the short covering is likely to begin soon and speculative buying as well. And in this webinar, a little bit later on, I'm going to show you why I was saying this. What factors contributed to this analysis and what made me to conclude that now is the time when you should be rather buying than selling. Again, looking at the chart now, it's easy to say, of course, down here, you should be a buyer somewhere here all the way up. But when the price action is evolving, it's much more difficult to do that. But there are tools for instance, multi-time frame analysis that helps you to do this. And after this webinar, you know so much more. So I'm not gonna go through my background that much here, but for those who haven't seen my webinars before, you can see my previous sort of activity and background here. And in my current role as the Chief Market Analyst for Tier Markets, I'm supporting you through my written market analysis and my daily market commentary videos, and I'm supporting you through the trader education that we do at the moment on a monthly basis, but maybe more in the future on weekly basis or so. But the whole idea is that you will learn things. I will show you things, you will copy them, we go over them and again, so that you learn to apply those things properly in your trading, and you grow as a trader, and eventually your trading account grows as well. And before we move forward, I have to mention this, that I'm really actually excited about Tier Markets, because it really is a low-cost trading environment. You can have a awesome subscription package, which allows you to have 0 commissions and raw spreads. I mean, then you just pay the subscription and you know exactly what your fee, the trading fee is going to be, or the fees in total is going to be for a month or for a year, because you know them beforehand. So you can trade as much as you need to, as much as your strategy says you have to, and the cost is always going to be the same. This is exceptional. And on top of that, you have raw spreads and me helping you to learn and grow. So the second part of the webinar is really about what makes good trading strategies, understanding seasons, which practically means market timing, really. And then practical real life examples. I'm going to show you some examples that I have been involved with, and you might have been reading about them in my analysis before, but now I'm going to here live teach you and help you to understand what went into my thinking or decision-making process and what made me to conclude certain things. So let's move ahead. Now, a good trading strategy. Promised to talk about good trading strategy. Last time we were looking at a bad trading strategy, which helped us to understand a lot of the different aspects that go into building both bad and good trading strategies. And now we're going to focus on good principles only. So first of all, there's no one size fits solution. Personalities are different, past experiences differ. And because some of us are very quick, thinking on their feet, getting bored easily, they are very different traders to some other people who, you know, they just love to take their time, think things through, study things properly, and then after a sort of long period of consideration, make a decision. These people will make very different traders. And also, because our past experiences differ, we have different mental schemes in our heads, because the way our brains work is that we store these experiences and create a logic based on those experiences, so that if we see things happening again, roughly the similar manner, we take those past experiences and we use them in formulating approach in the present time. And we make the decisions based on those past experiences. And obviously, Our emotions are impacted big time by the experiences in the past. So if you have very negative experiences on risk taking, that's going to impact your risk aversion levels. And yeah, so let's move forward. I could talk about this so much. There's so much to talk about your personality and the impact of the personality into trading, but we need to move forward so that we can cover all the material that I have for you today. Now, it's obvious that we come into trading world with different skill levels, so don't expect to be something at day one or year one. Really, you need time to learn. Learning is a time-consuming process. Our stress management mechanisms differ, so that's why some people are very good at trading fast, and some people are very good at trading something low risk that moves slowly. So that's why there are different markets, because the markets themselves, like stocks are a good example. You might have a very fast moving stock versus something that is slow. And the reason for these differences are the people trading those markets. And yeah, again, I could talk about this more, but let's move forward. Our goals are different, life circumstances are different. So if you have a full-time job, don't expect to be able to fully involve yourself into intraday trading. You need something else, and we can touch upon this later on. Now, find a strategy that suits you. If you are a slow thinker who loves to take his or her time deciding what to do and formulating an opinion, you might love to look at the weekly charts, and then maybe after you've established an opinion, use the daily charts for execution. If you are a little bit more like me, I think you will enjoy trading the daily time frame swings. A little bit like that gold trade earlier. You see gold coming to a certain level and you see certain things happening, and then you take a position and let it run for a few days. I have to say there are challenges there, and we can go into those, but there are also positives. So, like anything in life, there'll be things that are difficult, there'll be things that are lovely and easy, and it's always a balancing act between those. Then you might be somebody who loves to turn intraday trades into swings. You want to create a position throughout the day when you see the market moving in your favor, and then you just want to keep that into the second day or third day, as long as the market confirms your thesis and your idea of the trade. Then if you are somebody who's really, really fast in thinking and making decisions, you might want to be a sort of high frequency scalper, going in and out 1 minute charts or 2 minute or 5 minute charts, very quickly taking profits and very quickly taking the losses too. But yeah, let's move forward again. I wanted to remind you again that trading is 100% about psychology. So that's why it's so important that you have a strategy that fits your personality. I'm going to give you some ideas, some principles, some components of a strategy, but then at the end of the day, you will be the one that decides, and I'm here to help you in that process, but you will eventually be the only one who can decide what really suits you. You might need a coach like me to help you to understand yourself better and your feelings and your questions, to get answers to your questions. And you might need my help in understanding why you do certain things, even though you necessarily don't see them as useful. A lot of traders do the same mistakes over and over again. And if there is somebody coaching them, then it's easier to see that, okay, this is something we should replace with some other activity. But again, this is something for future webinars. Your questions are welcome. So in the chat box, if you feel like you want more clarification on something, please let me know. I will either answer at the end of this webinar, or if not possible due to the time constraints, I will help you via email. Now, some people, especially new traders, sometimes fill their charts with loads of different oscillators, lines, Bollinger Bands. I mean, loads. I've seen charts that are hardly readable because of all the different indicators that are there. And that is nonsense. It might be exciting, but be careful. Everybody gets out of the markets what they want to get out of the markets. If you want to get some excitement, there'll be enough excitement for you, I'm sure. If you want to get trading outside of the markets, you can trade, you can keep on clicking that mouse. But if you want to increase a trading account, then you have to do things that make sense, something that is kind of time tested, something that is solid and known by the financial industry and the academics also as being something meaningful. We can talk about these later, but momentum is something that I value a lot. And obviously, when the markets are moving sideways, you need to understand mean reversion. You need to understand supply and demand and supports and resistances and correlated markets. You need to understand the role of volatility. And actually, here, let me show you something. Volatility reminds me of something that is good to demonstrate with a cable chart. So let me bring this chart up for you. So here we have a 15-minute chart in cable. And as you can see, we have periods where market has been a little bit sluggish, and we have periods when the market moves. So if we, for instance, take this period here from, say, 8:45 my time, which is roughly 5:45 GMT, up to, say, 9 o'clock next morning, which is about 6 a.m. GMT. This is the Asian session. This is when the markets often move sideways. And if your strategy needs a low volatility period, then this is a period that you want to trade. You just go in and out, buying at support, selling at resistances, but don't expect the market to move a lot. If your strategy needs volatility, then obviously you want to be trading the European and American sessions when the volatility is much greater in this currency pair and frankly in many other pairs too. So that's probably enough about volatility right now. We can go back into this in later webinars. Let's move on. I'd like to have this full screen. And again, please ask questions if you have. Now, a good trading strategy takes into account different time frames. It's very, very, very difficult and challenging to trade a market based on only one time frame, whether it's daily or weekly or 1 hour or 2 minutes. But the rule is the smaller the time frame, the less information one bar has. That, if you take, let's take this gold chart, for instance, as an example. Here we have gold. And if we go to a 1 minute chart and take any one of these candles, they represent the decision and thinking process of a very limited number of traders compared to a 4-hour candle. Here we have quite a few people over this 4-hour period, quite a few more people over this 4-hour period making decisions about the price than over that 1 minute period. So it doesn't make sense to sort of constrain yourself to only one time frame. If you look at the 4-hour, if you look at the daily chart, if you look at the weekly chart, and once you learn to read these markets, you have so much more that you can understand about the market that you want to trade. Then a good strategy takes different correlated markets into account. So look at what the major USD pairs are doing, what gold and oil and equity indices are doing, because a lot of these markets are traded against the dollar. So if you are buying gold, for instance, you're effectively saying gold is better bet than US dollar. So you are choosing gold over the US dollar. Now, looking at these other markets, oil and major USD pairs and equity indices, especially in the US, you can get more insight and understanding on what the others are doing. Again, it's the same principle as earlier. We talked about this difference between 1 minute candle and 4-hour candle and how vastly different number of traders you have in those two markets. And the same principle applies to this analysis. Again, if you can read all the major USD pairs, if you can read gold, oil, equity indices markets, then you have a better idea of what the majority of the traders are doing, what they are thinking, how they're seeing the market. And that helps you to decide what to focus on. Do you focus on long trades or short trades? Do you focus on anticipation of market moving higher, breaking the resistances, retracing to supports and attracting buyers, or is it going to be the exactly opposite? Obviously, these markets are different markets and correlations break every now and then because traders are kind of focusing on different things. But it is better to use this sort of tool in your toolbox or include in your toolbox a correlation and correlated markets. It's better to do that than just follow one single market. Then let's take a practical example. Obviously, a good strategy pays attention to a lot more than entry, but because of the time constraints here, I'm going to mainly talk about just long entry component of a strategy. The other components would be the risk element. How much risk do you take per trade? How far the stops are placed? And how do you decide how big positions you take? Because some people trade they always trade one unit, whether the unit is micro lot or mini lot or full standard lot. They always trade this one unit, and the risk that they take varies unless they have a very solid idea. They just want to always have 20 pip, 30 pip or 50 pip stops, then obviously the risk is always the same. But there can be variation in your risk. I'm going to talk to you about this later on in other webinars. And because it's better to place the stops at certain places, not too close to the market. Now, long entry component of a strategy. It could be that you want to see momentum to the upside. And this is one of the favorite things that I do. I want to identify the market that is attracting money, market that is moving higher, because only big institutions can move the markets higher. You and I, we don't have the funds to do that, but the big investment funds, big banks, they do have the money to, especially when they think the same, when they all agree that this market is likely to go higher, then they will act accordingly. And unless there is, they actually do that until there is something in the price action or in the news that makes them to reevaluate everything, and then they might change the direction or go in cash. But anyway, market momentum to the upside is highly important component in my long entry strategy. Then I want to see a pullback. I want to see that some of the because markets go to they sometimes go to extremes. They go too far and then they have to revert back to the mean. They have to revert back to a support level, and that's where we look for long entry signals. And for those signals, we again need another webinar. This is really just scratching the surface. But we take the entries at support, or that's what I like to do. And I want to see correlated markets confirming this. Let's go and see this gold market again. I'm going to use this as an example. So here are 4 charts. Obviously, we don't have to pay attention to these at the bottom, but let's look at gold. I have here gold against the dollar, and over here gold against euro. And basically my analysis idea, or my strategy, long entry strategy, then comes a severe pullback. And I want to know how deep is this pullback, because if I use Fibonacci retracement levels, and I'd like to draw them from a major low to the latest high, and if I see the market coming all the way down to the 50% retracement level, I know that this has been very significant moved lower, and anyone who was selling up here would be thinking, especially when the market comes close to the trend line, the rising trend line here, a little wider so you can see it better. So the rising trend line here and the 50% moving average, 50% retracement level, I meant to say, that's when a lot of traders start to think, maybe I should just in case take some of the money off the table. And the others know that too. So those that didn't be in the market, they didn't have a position in the market, and they want to get back into gold, they start thinking here, okay, maybe the others are starting to take some of the winnings off the table. That means they have to cover their shorts. So if they sell up there, there have to be buyers down here, and others start to buy too. And this was my logic when looking at this gold setup that worked out so nicely. Then at the same time, if I go to, let me see, if I go to Euro USD, and I have to go to the daily chart, and Euro, it was 12th of August, and then here, 12th of August is in Euro here. Okay, so what can we say about this highly correlated market? This is another market trading against the dollar. Any ideas? What do you think? So you can type your answer to the chat box. Oh, thank you, Helen. Thank you, Stavros. Very nice to hear that. Lovely to have you supporting me. Excellent. So maybe I'll just answer this myself. I made the same observation here. The market is rallying higher. This highly correlated market is moving strongly, and then comes a period of sideways movement. But the market isn't selling off. It has a support here. Obviously, at the time, we didn't have this. At the time, the Fibonacci retracement was the highest high was there. Okay, so the 23.6 Fibonacci support was there, and the market had made a low there, and the market was trading above this low. So Euro was close to the support, gold was close to the support, and we had in both markets similar situation where the markets had been rallying, so there was momentum in the recent price history, and then a pullback. Gold being a much more volatile market, it had corrected big time lower, but at the same time it was close to support. And the same was visible in another highly correlated market, gold against euro. So just to save time, I'm going to move forward with this, but suffice to say, you need momentum to consider a long market. You need momentum to have the big money on your side. Then you need a pullback to take sort of extreme pricing out of the market. Then you buy close to support. And if you have correlated markets confirming your trade, then you are much better off than looking at only one market. And if you look at multiple time frames, then you have even more information to support you in this. And don't worry if this is kind of difficult at the moment to grasp everything. It is, when we are presented with something new, it takes a little time to sink in. But over time, you sleep over it, and your subconscious mind starts to working on it, starts to sort of clarify the things that you have learned, and you start to see the connections between things, why they are important. And over time, you'll be able to bring these things into your decision-making process, and you get better and better and better. I would say one of the most important things is not to aim to make money, but to aim to become better every day. This is something that one of the sort of my favorite authors, Mike Bellafiore, is always focusing on. Get better every day. Whatever you do, approach everything from the perspective that you want to be better today than you were yesterday. And over time, that will work. you become a better trader, or anything else in life. If you want to learn to play guitar or drums or violin, you just have to focus to becoming better every day, and you'll be better over time. There's another example. I want to be quick because we are running out of time. Tesla, I was writing about Tesla when it was rallying higher, and this was the time when there was sort of news report that the Tesla shares will be split, and usually that is another piece of news that supports the share price. And I won't go to details why, but just for purposes of this presentation, that's what happens usually. So I was saying that as long as Tesla honors the support, here we have a previous resistance coinciding with that 23.6 Fibonacci level. As long as market honors levels like this, you're good to look for long trades. Don't try to short a market like this. When market is bouncing higher from support, that tells you institutions are buying. You don't want to short against, you want to be on the other side of the trade when the big money is buying. And this is what happened after that. Tesla rallied higher, retraced back to the previous high, then rallied higher again, extended beyond this channel, and then started to correct lower. So it's as long as the market is acting like this, as long as it's not breaking the support levels, then you want to stay with the market. Let's see actually, just very briefly, what's happening with Tesla stock now. Let me see. Okay, here is the chart, and ESLA is the ticket symbol for Tesla. And as you can see, here we had one of those, there it goes. Here we had one of those levels that I drew on my charts earlier. Here's the little retracement, and then market moved higher. Now the same level has acted as resistance yesterday and today. So if we go to, let me go to 1 hour chart, you can see how the market rallied to this level and then dropped. So something has changed. Market isn't similar anymore as it was here. And obviously we need to think about, with stocks analysis, we need to think about what happens with stock indices and other markets. So that's a whole different story there. And the last example, Euro USD, loss of momentum. I was saying in this analysis that a short-term move lower is likely. We don't tell you that the price is definitely going to go somewhere. That's not wise because we don't know. Nobody knows the future. But we can say that the probabilities are increasing, that the market is moving to a certain direction, and we can say it's likely without giving investment advice. Now, then I was also saying that based on the current technical and fundamental setting, we believe it's likely that the correction will be only short-lived, and we will be met with new buying at levels closer to 1754, which was this here. And then market came down here and rallied higher from there. Okay, so just to finish off this webinar, please remember that you will have my support through the daily commentary videos and the daily market analysis that I write for you. And you have super tight spreads and ultra low trading fees with TO Markets. So this is a great package for you, and I look forward to many webinars with you and I'll support you. If you liked this, please give feedback. And if you didn't, also, I would love to hear why, so I can develop what I do to better serve you, to better help you, because I'm excited about helping TO market traders to become better and grow their accounts. So thank you for this webinar. Trade safe, be careful as you trade, and don't hesitate to ask those questions. Thank you so much. Okay, thank you, Julian. Thank you, Helen, and thank you, Stavros. It's been great to be here with you. If no questions, I will call it a day now, and thank you so much. See you in the next webinar.